Hi, I'm Gary Stone, Senior Portfolio Manager for First National Wealth Management. Today, we're going to talk about interest rates and what happens to a portfolio if interest rates decline in 2026. The Federal Reserve controls the Fed funds rate, an overnight lending rate, lowering that rate 3 times in 2025, 0.25% in September, October, and December. That rate now trades in a range between 3.5% and 3.75%. Despite political upheaval and concerns about the effects of blanket tariffs on America's trading partners, the S&P 500 was up over 16% last year. Lower interest rates helped to fuel a portion of that appreciation in the U.S. equity and bond markets. Many companies need capital to expand their business, and often that capital is borrowed from financial institutions or through the corporate bond market. Lower interest rates make the cost of capital less expensive. Therefore, reducing debt service can increase corporate profits and lead to higher stock prices. Smaller, less established companies, for example, tend to borrow heavily and benefit more than large companies with less indebtedness. Often, investors compare stocks, which are referred to as risk assets, to risk-free rates of return. When interest rates drop, CDs, money markets, and fixed income investments become less attractive. Conversely, higher dividend-paying stocks become more attractive compared to the lower yields found in risk-free assets. Higher-yielding assets like dividend-paying pharmaceutical companies, real estate investment trusts, master limited partnerships, utilities, and telecom stocks are particularly desirable in falling rate environments. Bonds also react to lower interest rates, benefiting often in a similar way to dividend-paying stocks. Lower rates increase the value of existing bonds and may attract investors looking for higher yields. The increase in value of a bond as rates decline is dependent on whether the bond matures relatively soon or farther out in time. Bonds also provide protection in a portfolio that might otherwise be too dependent on stocks. An increase or decrease in rates may affect the value of risk assets like stocks more than bonds in a portfolio. Owning both can lower the volatility in the overall portfolio. It is important to remember that falling interest rates may be symptomatic of a weakening economy, or one in which inflation is falling as consumers curtail their spending habits. Although falling rates may have an immediate positive impact on stocks and bonds, eventually stock and bond prices will react negatively to an economy in decline. Will the Federal Reserve continue to lower rates in 2026, helping to promote higher stock and bond prices? That question remains to be answered as the markets look at factors such as unemployment, consumer confidence, and geopolitical events for clues.